Welcome to Investing Insights. I'm your host, Ivana Hampton. A shift in mindset can help investors cope with market uncertainty. 2025 was a case study in the futility of trying to predict the market. Wall Street had lofty expectations for stocks entering the year. Then the tariff shock in April rattled the markets, and many firms lowered their annual stock forecasts in response. They later raised them after stock prices rebounded. With the new year on the horizon, Morningstar's new global investment outlook is offering investors tactics to weather whatever the future may hold. You will hear conversations with Morningstar strategists and analysts on this podcast about key challenges facing investors in 2026. Dan Kemp is kicking off our series. The Chief Research and Investment Officer with Morningstar Investment Management Europe is one of the major driving forces behind the report. Welcome back, Dan.
Ivana, it is great to be back. It's great to be with you. Thanks for having me back on.
For sure. Now, we typically talk about your Markets Brief column, but today we're focusing on Morningstar's 2026 Global Investment Outlook. The theme is preparing for what comes next. What will investors looking for ways to cope with uncertainty find in this in-depth report?
Oh, thanks, Amanda. What they'll find is a framework rather than a forecast. We know that markets are inherently uncertain. So instead of pretending that we can forecast the future, what we've done in the report is answer the key questions that we're hearing from advisors and investors and helping them think through some of these challenges in the year ahead.
And what makes Morningstar's outlook different from other companies?
Well, one of the challenges that we see in other outlooks is that they contain a lot of overconfident forecasts about what's coming in the year ahead, and we know that forecasts are the mother of surprise, and surprise can be a really bad driver of behavior. And so, what we've done in our outlook is, as I say, try to answer the questions by helping people think through the challenges, understand the uncertainty, and set up their portfolios for a range of possible outcomes rather than just anchoring on one outcome in 2026.
And you've written about how a few ideas from the Global Investment Report resonated with you. What are they and why?
Well, absolutely. I think that the first one, and probably the most important, is that successful investing requires independence. As an investor, it's so easy to just go along with the herd, to buy things that have gone up and seem to be popular with everyone else. But as an investor, it's so important to be independent, to think independently, to look in those parts of the markets that are unloved, that haven't been performing quite so well, because that's when you're more likely to find the great investments of the future. Whereas buying things that have been very popular, going with the herd, can cause problems. Second, capital cycles matter. We tend to extrapolate the current situation far into the future. We assume that what's happening today will carry on happening. But in reality, all markets are cyclical. We've seen that particularly over the last year. We're seeing it now with some of the big lumps of capital that are being invested in AI and other areas. But you have to remember as an investor that these things are cyclical. They go up and down through time. So keep that in mind. And then the third thing is that you need a portfolio that's going to serve your needs as an investor and not just be focused purely on generating the highest return. You've got to have a portfolio that fits with your overall risk tolerance, but also one that fits with your objectives. So we cover income investing in the portfolio, some of the challenges there when interest rates are falling. So again, focus on making sure your portfolio fits your needs.
And as we wrap up our conversation, what's a lesson from 2025 that you want investors to take into 2026?
Well, I think the key lesson of the last year is that investors have to be disciplined and focused on long-term goals, and to resist the temptation of reacting to every headline. If you look back on 2025, the event that probably stands out for all investors is the announcement of the tariffs in April and the market turmoil around that time. And first of all, markets fell and then they recovered. You could have got yourself into a horrible mess by following every headline, by selling when everyone was panicking, and by buying when everyone was confident. And so it's so important as we go into this next year to learn that lesson, that when we're surprised, we tend to make mistakes. And so stay disciplined, stay focused, make sure you've got a portfolio that fits your needs, and then that will see you through whatever 2026 brings.
Well, Dan, thank you for helping investors focus on preparation instead of prediction.
Thank you.
Now we're going to dive into research analyzing the AI arms race and its worldwide buildout. A team of Morningstar researchers have investigated the spending and the risk. Morningstar Research Services senior equity analyst Brian Colello was part of the effort. Brian also covers Nvidia, and we're going to discuss the AI King's outlook, competition, and stock. Welcome to Investing Insights, Brian.
Thanks for having me.
Well, big tech is spending hundreds of billions of dollars on this global construction boom. One, where's the money going? And two, how does it compare to other sectors like energy?
Sure. I'll start with the last one first. This spending is much higher than what you would expect from an industrial, a heavy construction sort of industry like energy. We are seeing one of the biggest construction projects basically in the world. We've seen some studies that as a percentage of GDP, AI is already bigger than the build out of the internet. And it's really just lagging behind railroads in the late 19th century. So that's the size of the spending that we're seeing right now. The money is going to these clusters of GPUs, racks and racks and racks of servers, and all the most advanced technology in the world to put the GPUs into server boards, into racks, and glue those all together to get them all talking, to train AI models, and then to conduct inference, which is just the running of queries to give answers back to customers. And we are just seeing an explosion of this data. You know, it's all the hundreds of millions of users of OpenAI. You see it at Gemini, you see it at Google, you see it through the largest companies in the world, and then many, many more software companies trying to build on top of AI. So it really is just a massive, well-coordinated construction project. And the companies that are building this out are either able to rent that capacity out to others, like in cloud computing, or using it for internal purposes to build the greatest model in the world. And that's what OpenAI is trying to do, and Gemini and Grok and many others. So it is a race to the top right now. And the more you can build, you could potentially get a better model. So they're in a race. There's no reason to let a thing like capital slow down this build out.
This massive build-out comes with execution and cost risk. What's at stake if hyperscalers underestimate these challenges?
Sure. Yeah. And there are challenges and there are risks to all of it. So supply chain is one. Can they even get enough to build what they want to build in the first place? Energy is another one. Who is going to power all of these data centers? The industry is scrambling for as many gas turbines and solar locations as they can get. And nuclear is potentially on the way, but obviously that still takes a lot of time to build out. There's the funding of it as well. So you've seen Nvidia, AMD, others sign massive deals with OpenAI and to a lesser extent, Anthropic, to build out tens of gigawatts of data centers. So 1 gigawatt can power a city like the size of Indianapolis, like hundreds of thousands of homes. So when you talk about tens of these being built out, it is massive construction. So OpenAI has these plans for tens of gigawatts. They have a blank check right now from investors to spend on that, right? They haven't turned on the tap to get revenue yet. Will that funding still be there to build all this out? So there are still a lot of risks. And then even for the hyperscalers, there is a big question on return on investment. And that's something we're all thinking about. They're spending a lot now. Will they earn the profits 1, 2, 5, 10 years from now to make up for that? So these are all sort of considerations for investors. And this is what makes a market. So, you know, we're very optimistic on AI as a technology, but there are potential speed bumps along the way, either in getting the technology out the door or the profits that would come thereafter.
Thank you for saying 1 gigawatt equals powering a city like Indianapolis. That's something we can take with us. How is AI affecting sector valuations, and how does it compare to the tech bubble from the late 90s?
Yeah, we are seeing, depending on your metric, some valuations on par, some of it's a bit more reasonable. So in our outlook, first we looked at a price sales ratio basis. That multiple is actually on the higher side. Now, I'm the Nvidia analyst, and I can argue that Nvidia earns a 50% net income margin on it, so it should have a higher price to sales ratio because those sales convert into net income dollars versus when you had unprofitable companies during the dot-com boom. So that might be one way to explain that metric, but certainly the metric is high. Price sales also tend to be higher in software, particularly the SaaS business model. You spend upfront to get customers, you reap those rewards later once you're sort of locked in and build out for the customers. But still, that ratio is pretty high. On a price earnings basis, still higher than normal, but not as high as the dot-com. And again, you could point to the dot-com era having far fewer profitable companies. So of course, like those price earnings multiples were very high. The denominator of the earnings was very low. You have, to date, most of the spending has been done by the highest quality companies on earth, right? Microsoft, Google, they are cash cow businesses. They have the cash in the bank to spend. They didn't even have a great M&A environment to make mega deals for anything else. They would struggle to get some deals out the door to acquire companies, but they have no problem buying GPUs. So that probably fuels this build out as well. But to date, you have the spending by the biggest companies in the world. So I think investors generally feel better about the earnings quality of an Nvidia, of a Microsoft, a Meta, Google that build this out. If you look at our price to fair value ratios as analysts and the intrinsic value of what we think these stocks are worth, stocks are basically fairly valued, maybe even a little bit undervalued. Now that we've had a little bit of a pullback in AI names, they've fallen a little bit out of favor and a little more maybe risk is priced in. Again, I'm the Nvidia analyst and I'm actually bullish on Nvidia. I think this is actually a reasonable entry point. I'm at a 240 fair value estimate and the stock's trading around 180. So we're actually seeing some slivers of opportunity as AI has fallen a little bit out of favor in recent weeks.
Now, Morningstar believes that many investors are already heavily exposed to AI due to big tech size and broad stock indexes. How can folks counteract this?
Yeah, that's a great point. Investors are exposed to AI right now, like it or not. So if you own a broad market index, the Magnificent Seven makes up a significant piece of that. And we'd argue 5 of those 7 are highly exposed to AI. And Apple and Tesla, if they're not there yet, they're going to get there. So that AI will still be a piece of those businesses, of course. And that's, I guess, not counting what Elon's doing on his other business of XAI. So certainly he's in the game as well. So a lot of exposure in broad market indexes. I would even argue you could look at what would be considered a value index, like a dividend index. You'll still get possibly AI exposure there. Microsoft, Oracle, Broadcom are big dividend payers, highly exposed to AI, but still generate a lot of cash flow that can be paid out as dividends. So investors will have exposure, so it's worth thinking about. One index product that we have at Morningstar is the Wide Moat Focus Index. It's based on IP from our equity research team, where we identify undervalued wide moat names. That's an equal weighted strategy. So among names that enter, you never get more than 2.5% weighting into that index. So we do have a list of holdings that does look very different than broad market indexes. And we tend to go in places where we see value. So, in recent months, at times where AI looked expensive, we've been overweight healthcare or consumer defensive. And so that's a product where you can look and see exposure to sectors outside of just massive tech. That doesn't mean that index won't like tech. If you get a big AI sell-off and it's unjustified, you might see tech right back in that index. But that's an index that goes places where we see value.
I am very excited to have you here because you are the Nvidia analyst, and everyone listening, watching, believe me, I've been trying to get Brian on the show, so this is an awesome time for us. Let's pivot to the AI industry leader.
Okay.
So Nvidia took a big hit when DeepSeek arrived in January, but the chipmaker also became the world's first $5 trillion company in October. What are your thoughts about the year that Nvidia is having?
Oh, it has been a heck of a year. It's been, DeepSeek seems like a lifetime ago when that sort of sold off. So it's been a volatile year, but it's been a successful one too. And I think investors sometimes might miss that. They have still generated tremendous growth in calendar 2025 through this AI build out. And again, the build out is massive and ongoing. So, even recently, as you get concerns of an AI bubble, and we heard this on the last earnings call, Jensen Huang, the CEO, addressed this directly, that investors are concerned about a bubble. We see something different, and they are trying to catch up to demand still, and demand still exceeds supply. So very volatile year. DeepSeek, I think investors were rightfully concerned that if you get a more efficient AI model, that means less of an AI build out, less Nvidia chips, everything's sort of sold off. And that wasn't the case at all. The argument you heard then was Javon's paradox. Well, okay, if AI becomes more efficient, then we're going to use AI in more and more places, so demand is still there. We definitely saw that. We saw no sort of slowdown in CapEx among the leading hyperscalers, no slowdown in Nvidia revenues. So that risk sort of came and went. And that's how I would think about future advancements in efficiency and AI models as well. There's just more and more places for AI. And even as we think about this build out, and if you think about, let's say your ChatGPT usage, right? OpenAI is trying to get more users, trying to get more usage per user. And then with new techniques, there are more tokens being generated to get that query into your hand. So all of that is creating just a massive need for compute. And that need is still there. And so, NVIDIA's had a very successful 2025. They're effectively guiding to a really successful 2026 as well. Again, they're going to keep selling everything they can make next year as well. If you have bubble questions or concerns, or, you're thinking this is too much too soon, possibly, but I don't even think it's a 2026 issue at this point. I think you can question that down the road, but from everything we're seeing, demand still exceeds supply. And I think that's going to be the case in the near term and maybe even the medium term.
Now, rival chipmaker More Threads recently made its market debut in China. What would it mean for Nvidia if China comes out with more advanced chips?
Yeah, well, I would say they are going to come out with more advanced chips. There are plenty of companies. And in general, if you take a step back at Morningstar, we believe capitalism works. If you have a big market and a lucrative opportunity, companies are going to come in and try to tackle it. So no surprise to us at all. They have many names in China trying to build AI processors, many names in the US trying to do this as well, like Qualcomm, very large tech name, starting to enter the ring in AI as well. But the US-China restrictions kept Nvidia out for a bit, or even best case, Nvidia was selling really throttled down chips into China. So China has a need for more processor makers. So you are going to see advancements there. Now, again, you asked me this on a Monday, and I would tell you that Nvidia is not allowed to sell into China. We're here later in the week, and Nvidia is selling into China now. They're reportedly going to be able to sell their H200 chips, which is basically their 2-year-old but unthrottled chips into China. Now, that's just one step because the Chinese government has come back and said, we don't really want Nvidia in the country anymore. We'd rather have our own ecosystem. We don't want to rely on the US. So we'll see if there's even adoption, whether the Chinese AI builders want that Nvidia gear, or whether they'd even be allowed to get it. So there's still steps, which is why when that news came out, we didn't change our fair value. We haven't changed our estimates yet. I think there's still more work to be done to figure out what will happen with this approval. But yeah, the competition's coming from all over the place. We still think NVIDIA has a multi-year head lead on processors. Probably more important is the software that goes around it, all of the apps and the libraries. NVIDIA was at the ground floor of the large language model. The first big breakthrough, the big bang moment, they say, was run on a reprogrammed NVIDIA GPU. And what NVIDIA did for the subsequent 10, 12 years is build out that software library to make it the place to build large language models. And, go back to the beginning, if most everyone's model is based on NVIDIA gear, like, you're not going to try to switch chip providers midstream just to save on cost. You need better and different reasons for that. So I do think NVIDIA has that, certainly the early mover advantage, and they're doing everything right to keep that advantage and stay on top of the market leadership. Google's a little bit different off to the side, as they're vertically integrated and have done everything else. But for everybody else, I think NVIDIA is still the place to be.
Two things. One, we timestamp on Investing Insights. It is Wednesday, December 10th. And then you brought up Google. Interest is growing in Alphabet's chips. Can NVIDIA fend off competition from one of its customers?
Sure. Yeah. And that's one of the risks. And there are many risks around NVIDIA's investment. But again, massive potential opportunity too. So Google has done a very impressive job, as you would expect. $1 trillion company invested in DeepMind. They've been at the forefront of AI for quite some time. So what they've come out with recently with Gemini 3, very impressive on benchmarks. It looks like it's real competition, maybe like a step ahead now of OpenAI, Anthropic, and everybody else. And I think, maybe chatter 6-9 months ago was that Google was maybe behind in AI models. Now they've stepped ahead to the forefront. They've put out impressive products, and it was trained on their own in-house chips. Google is probably one of two large hyperscalers, Amazon the other, really focusing on their in-house chips, in addition to Nvidia, and I'd say even in addition to AMD as well. AMD is going to have a place sort of as the alternative to Nvidia for a lot of other customers. But Google has the entire stack to program their TPUs as they see fit to run training and inference models, and they have the full stack, and they came out with an impressive product. I think every other company in the world will struggle to replicate what Google has done, and so then that means being reliant on Nvidia. And by the way, Nvidia, we say this now that TPUs and Gemini had a good breakthrough. OpenAI is coming, and Anthropic's coming, and they have a deal with Nvidia as well. Nvidia's Rubin product is coming out, a few months from now. So, just like a boxing match, like get Gemini threw a big punch, like the others are going to punch back, and so that I think that's why we've been didn't really shake us too much in terms of our fair value. We've always thought that ASICs, like Google's TPUs, will be a piece of this market. Nvidia will lose market share, going from 100% basically down to something smaller than that. But the pie is going to grow so massively because we're still seeing so much of an AI build out that Nvidia will still grow quite nicely. And again, AMD will take a sliver, custom chips will take a sliver. Now, again, if you're bullish on Google, you can make an argument of how big the piece of the Google pie will be out of all that. We saw Meta maybe potentially partnering with Google to get its chips. Now, if Meta gets those chips in their hand, will they be able to do exactly what Google does? Not yet. Will they be able to put software around it to maybe get close? Maybe. And maybe instead of all the hyperscalers building their own custom chips, maybe they all rely on Google as the de facto custom chip. I think that's a possibility at least. But still, those custom chips like TPUs, they cost less. They're built for a specific purpose. The trade-off is they're not as flexible. They can't, if you're using them on Google, you're going to run them in Google Cloud. You can't really bring those to AWS or Azure. So there are trade-offs. And so that's why ASICs will probably be a piece of the workloads, but probably not the majority. I think Nvidia is still in a good place.
And we talked about this off camera. You own Meta and Microsoft.
I do, yes. So I don't own any stocks in semis, but those companies that buy, it's hard to avoid.
Now, you mentioned NVIDIA's fair value estimate earlier, but we're going to put this all in a nice, neat box for everyone. What is your outlook for NVIDIA and other chip makers? And which of these companies do you think is undervalued?
Sure. So right now today, thanks to the sell-off, NVIDIA and AMD appear undervalued to us. And that's not something we would have said even a few weeks ago. So for the size of these companies, stock prices are moving quickly because the space is moving so rapidly. So again, with Nvidia, I'm at a 240 fair value estimate. The stock's trading around 180 or so. There has been concern about the rise of Google, and thus, and certainly it's a problem. If OpenAI dies is a very strong word, but if it starts to lose market share and lose users, and many users gravitate to Gemini, certainly that's a problem for anybody outside that ecosystem. So that's not just an OpenAI problem, but an Nvidia and an AMD problem as well. So I think that risk is priced in. I think that, again, that risk is overstated because Google has the ability to do it all in-house, but I don't think others will. I still think Nvidia is clearly the place to be and has the software advantage, the networking advantage, can be moved across cloud. So I still think Nvidia is going to do quite well. And again, 2026, they basically guided to $300 billion of data center revenue versus $200 billion in total revenue in 2025. So massive growth coming again. And, they're putting out the targets to 2030. And I don't even think, certainly not at the current price, but even at fair value, doesn't fully blindly assume that they're going to hit the targets they're talking about in 2030 as well. So, I think I'm even cautious on versus the growth that they're already commenting on. AMD has come out and sort of corroborated what NVIDIA said. They think that silicon piece of AI is going to be $1 trillion by 2030, and I think AMD has generally been thought of as a conservative firm. So, we think AMD is cheap as well. AMD is a bit more leveraged to OpenAI. That was their first large deal, and that is the deal that will establish them as a true second source to Nvidia. Again, I think the sliver of the piece of the pie that AMD carves out will be small, but you don't need much in such a massive market. So there are many companies on earth would love to get 1% of this massive market. I think AMD probably goes somewhere between 5 to 10%, and that's still a big gap. And so I'm not even at, let's say, 10% market share 5 years from now. But if they're in a mid-single digit to high single digit place in the AI market, AMD's cheap as well.
What is the takeaway regarding Nvidia and the AI arms race?
The arms race is still going. It's one of the biggest, most consequential races we've seen at least this decade, or certainly this decade, and probably in the past 30 years, and you could argue maybe in the past 100 years. We've heard people say this is the biggest trend since the internet, and some have come on and say, no, it's going to be even bigger. So we'll see how that goes. I'm very excited about the technology and the pace of innovation and the breakthroughs that might occur from this technology. From the investing side of things, the 2026 again still looks pretty bright to us. Now you can have risks longer term and maybe shorter term. Maybe things will change rapidly. One thing that sort of concerns us, I guess I would say, is the spending is being led by a handful of people, right? And we know them by name. It's Mark Zuckerberg and Elon Musk and a few others. And Jensen obviously sees all of it. And so, I think he's orchestrating as much of it as possible. But it's leaders of these massive companies making the spending decisions. Potentially something happens and they change their thinking and they change their projections. And so maybe that's a risk. But otherwise, I think those orders are in. So again, the industry is building towards a great 2026 and more likely beyond. I mean, I guess maybe the biggest takeaway is not only because we've been getting this question for a couple of years now, right? Even when Nvidia was a $50 billion business, there was nobody thought this could continue. And now we're at 200 and now we're looking at 300, right? And so we're at a position where not only is spending not peaking, but it's accelerating from here. And again, longer term, that can make us nervous. Like, wow, if it's growing even faster, this is too big. But by the same token, demand is still really bright. We have not caught up to AI demand yet as an industry. And so I think, again, 2026 is going to be a good year. But as we highlight in our outlook, there are risks around energy and funding and return on investment. So we're keeping an eye on that too.
Brian, thank you for coming to the table for the first time.
You're welcome.
Please come back.
Happy
and
to
always
do so.
Share your insights about the AI boom with us. We appreciate it.
Good deal. Thank you again.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor Morningstar. Take care.